Quick video showing how you can use the Tradytics or Tradytics net flow tool for trading 0 DTE credit spreads on SPX. This is how I'm using the tool for my day trading. You can also use it for stocks and other instruments as well. But with SPX going 5 expirations per week, there's a lot of opportunity to sell premium if you establish a directional bias, and that's what this tool is kind of helping me do. And for those that haven't seen the tool, it's showing the net call and put premiums for all stocks compared against the price of SPY in 1-minute increments. I'm going to leave my referral link in the bio if you guys want to check Tradytics out. But this screenshot was taken about an hour after the open, in which I was already in and out of my trade. So I went ahead and just took a screenshot and went over this now. Let's go ahead and walk through it. So you're not seeing it in this chart, but the market did gap down a lot this morning. But as the market opened, we can see that the red line is the put premiums started to increase, and the green line was the call premium, which started to decrease. This is telling you that as a whole, the market is bearish, or at least the options market is bracing for bearishness. And when you combine these two lines into the oscillator below, it crossed over. You can see it started out as being green, and then it crossed over to being red. So it's telling you at this point that the market is bearish. So now I've established my directional bias, which is bearish, and now I can craft a trade that doesn't necessarily make money if the market moves lower. It will, but I can sell a call credit spread to collect theta because time decay is going to be on my side, and I can look for a bigger move lower to take profits, and that's exactly what happened. Let's go ahead and check that out. So now we're looking at a 5-minute chart of SPX, and you can see the gap down I was talking about. We got that initial move lower, and then we were getting this kind of sideways action into the 10 o'clock hour, which is about, Eastern time. That's about 30 minutes into the open. So the idea here was, now that I've established my bias, I'm looking to sell a call credit spread. I went out of the money closer to where the gap window would be, which I sold the 40-40 call and bought the 40-50 call credit spread for a net credit of $2.80. Because this is a 10 wide spread, my risk per spread is $7.20. It's the difference in the strikes minus the credit. So the idea here was, yes, we could get a retracement. So I wanted some room to wiggle. I went in small because if we were to retrace with that bearishness, I could add to the position. Now, as we can see over the next, this is a 5-minute candle, literally 15-20 minutes later, I was able to buy this spread back for $2, booking $80 per spread. So not a huge trade because I kind of wanted to leg into it. I thought we would retrace a little bit. We seem to be finding a floor, but at this point, I was able to book 80 cents of the $2.80 credit. That's about a third of the max gain, somewhere in there. And when you think about risking $720 to make $80 in about 20 minutes, it's about I'm going to call it a 10% gain or so minus commission. So pretty good trade, pretty good tool. You guys should check them out, and I'll see you in the next video.